Everyone. We are live today with another session for the Founding Titan Startup Ecosystem Series. Today we're going to be talking about mastering the dance of finance. We have Jeff Eversmann here with Longview Technology Ventures, and he's also a fractional COO and CFO as well. We're going to be talking about finance, equity, a lot of other categories today, including financial modeling and forecasting, as we go through on today's session. And to give a little bit of introduction, so Founding Titans, we are creating a community-focused relationship optimization platform, and we're building that to help pre-seed to Series A startups with finding the right connections and resources for their businesses. And so our platform is going to be launching soon here. I'll be pasting in the chat our website for everybody to go on and be able to sign up for our wait list. We currently have 7,000 plus people, including the communities that we already have signed up as well. And looking forward to launching everything relatively soon here. But I do want to kick it over to Jeff Eversmann over here to be able to give a little bit of background about himself, and then we'll start jumping into some questions as well. And it's also, if you guys have any questions, definitely feel free to throw those into the chat, and we'll be answering them as if we have time towards the end of the presentation as well.
Okay, great. I'll give a little bit of background on myself. I started working with startups directly after I got an MBA in entrepreneurship. And I actually made an attempt to start beforehand. When I was in Seattle, I met with some VCs, and I was a little naive at the time. I thought, I'll just meet with the VCs, find out what they're investing in, and then I'll go start a company in that area. And so I found out quickly that's not how it works. And so moved to Austin, got into an entrepreneurship program, and then started working at a startup doing product marketing, but soon got introduced to some founders that were trying to raise capital. And they were trying to raise capital from one of my MBA professors. And he said, I don't understand what they need the money for. I don't understand what their growth strategy is. And I don't understand what their exit plan is. Like, when do I get my money back? And so he knew from working with me in the MBA program that I could get in there and answer those questions for him. And so he introduced me to the founder. I started working with the founder on building out a financial model, and then just kind of doing that as a hobby. So that's what I did for fun. So I did product marketing during the day, and on evenings and weekends, I would build Excel models for startups. And it just grew from there, mostly through word of mouth, because back in that time frame, people would be sitting in coffee shops working on their pitch deck. Austin's a very small community. And so you get to slide number 9, financial model, and you look over at the guy next to you, and he's working on a pitch deck too. And so you'd say, well, hey, what do you do when you get to this slide? And he would say, oh, you call Jeff Eversmann. And so I started getting all these referrals to do other financial models for other founders to help them raise either their first round of funding or their angel funding, and eventually turn that into kind of my career. And so I decided in 2009, I wanted to switch over to finance. I've been doing it for fun. How do I do it so that I get paid for it? And that's when I started working with startups more directly as the senior finance person. And so did that for a few startups full-time in the consumer fitness space, enterprise software space, and then started doing fractional work in 2014, where I'm essentially working for anywhere from 3 to 5 startups at the same time, helping them go through their different inflection points in either fundraising or strategy or growth or building internal systems for scaling. So there's is that a quick enough intro?
No, that's an amazing intro, and definitely sets up some things for later with some of the questions we have planned. But no, I definitely resonated with you saying that you really liked building financial models for people. And that was just something you did for fun, because that was literally me back in the day when I was building business plans for fun, especially marketing plans for startups. And you never took any money, never took any equity for at least the first couple that I actually helped out with, just because it was fun for me. Right.
Yeah.
And I think there are a lot of people in the startup ecosystem that kind of have similar beginnings to us in that regard of, just kind of jumping in head first and seeing what happens, and having these amazing skill sets in some of these, really niche but very vital areas. Like, for me, it was marketing, for you, finance, and really being able to kind of provide a lot of that assistance as we've kind of gone through for our careers. So yeah, that's amazing.
Startups love getting help for free, so that it's
Yeah.
a lot of work if you're willing to work for free.
Yeah, exactly. But also, I mean, some of those relationships can pan out too. For one of the startups that I helped out for free, I mean, once they raised their seed round, and I actually got this offer from a bunch of different startups once they kind of raised their rounds or got to a certain point with their businesses, to, say, hey, we want to bring you on full time. That's actually what brought me out to Austin, Texas, is one of those companies that I assisted with. Now UltraView AI, one of those guys is now one of my advisors too, which is kind of, she was on the other foot in certain regards as well. So it's crazy how some of those things can actually pan out.
It is awesome.
Yeah. And so let's jump right into, some questions here. So let's talk about understanding early stage finance. So what are the critical components for financial management that every early stage startup should focus on? And, what are the common financial mistakes the founder should avoid as well?
So I think a big thing that founders should focus on is the 13-week cash flow model. And so even if you're not, a expert with Excel or big into forecasting, understanding where your money's going to go to in the next 13 weeks is critical. So 13 weeks is a common cash flow model because that's a quarter, and you typically have board meetings every quarter. And so what you want to do is you want to say, I know how much money I have. I know what money's coming in, what's going out over the next 13 weeks to make it to the next board meeting. And some of the better founders that I've worked with, they update their 13-week cash flow every week, and they know where they are with collections. They know where they are with invoices. They know what payroll's coming. And so they're aware of all that information, and they keep it top of mind, because they don't, as you know, running out of cash is not a good thing for a startup. And so they want to have as much visibility into where the money's going, and 13-week cash flow is the model to do that with, not your forecast model, not your 5-year forecast or your 3-year forecast, but a 13-week cash flow.
Yeah, no, I mean,
second part of your question, mistakes I see is not keeping good records. And so what I encourage people to do is, anytime there's a document that has to do with money, keep a copy. Whether it's investor checks coming in, keep a copy of that investor check, or wires, or you'd be surprised how many investors do not keep a copy of their convertible note or their safe. I mean, they will sign it and then it's just gone. And then 5 years later, they'll call you up and say, hey, do you have a copy of that safe? Or you've got to keep copies of interactions with employees. So every offer letter and every termination, unfortunately, whenever you terminate somebody and you sign some sort of separation agreement, you need to keep a copy of that. And so it's critical that you've got a good system for keeping records, because when you get to later stages of financing, when you start working with venture capitalists and they start going through due diligence and they see, I've got a co-founder on the cap table that's got X%. Okay, well, where is that co-founder now? Oh, well, we terminated him. Okay, well, where's the termination paperwork? Oh, let me see if I can find a copy. All that stuff you want to have in your data room. You want to have it ready to show that you can keep track of what's going on in your business.
Yeah, exactly. I mean, that's some of the things that, we focused on, and even things that I've actually told a couple of other founders, especially over the last couple of months, with a lot more people being a little bit more diligent in their fundraisers, especially as we kind of roll into September here, where, it's basically peak fundraising season before November hits and everybody takes a break until February of next year. So being able to actually, have a clean data room and knowing what documentation to put in there is extremely important, because I've also seen, deals that have been made or broken based off the information in the data room. Some people might not pay extreme attention to it. Some people go through it with a fine tooth comb, and you don't really know what ballpark you're jumping into. So it's better to actually have everything in a like all the ducks in a row and everything lined up properly, just so that also just protecting your business in general. It's not just about fundraising for having those documents, but also just protecting your business as a whole, because one of those co-founders could come back later and say that there are completely different terms or different information. And same thing with investors, where, you end up, bringing on somebody in your next round or whatever else it is. And there could be certain things that might be points of contention, and having everything ironed out in those documents and having those on file, could end up being your saving grace. Because I've also seen both ends of that as well, as I'm sure you probably have as well.
Yeah, and last thing you want to do as a founder CEO is, when you're getting ready to scale, have to go back and look for stuff. Like, you have to go back, and because sometimes one of the mistakes founders make is they start hiring technical people. They start hiring other executives, and they think, well, I don't want to hire an administrative person. We'll just do that. I'll just take care of that. And then what happens is the CEO becomes the administrative assistant for all these technical people that they just hired, because they're thinking, well, these developers are really expensive. I want to make sure they're spending all their time coding, right? And so now the founder's running payroll. And it's like, you're the most valuable person in the company. You're the one tasked with increasing the enterprise value, and here you are running payroll, or filing for sales tax permits in other states, or workman's comp stuff because you've got remote employees in Colorado or whatever it is. And so it's just interesting to see, because when I come in to help somebody raise their next round, that's one of the first things we have to do, is we have to clean up all these files that weren't organized in the past. And that's not a fun exercise for a founder CEO to say, let me look for that, or I can't remember what my login is for the state of Nevada or whatever. And when you can just keep good records going forward. But I also encourage people now, hire a virtual assistant or an admin assistant before you hire anybody else, because you want to focus on the most highest value things for building your startup. And it's not things like running payroll or doing administrative tasks. And you have friends that have access to virtual assistants it's much more efficient these days to hire somebody to do that, to maintain good records, and to be the person to track all this stuff down and spend time on phone calls with state agencies trying to figure out what happened with this filing that didn't get correctly done or whatever. And so that's not what the CEO needs to be doing.
Yeah, I mean, like you said, there are great options for that. Being able to actually utilize VAs. I actually know, a couple of VA companies that are really good. One of them that is in our partner list is Effortless Hire. And then also, the guys at Coconut VA as well, that, we highly recommend both of those teams, depending on really the aspects that people need for their businesses. But that is one of the main hires. But also, it's interesting that I've heard some pushback from investors, even with our raise, where, there's certain people that think that should be your last hire versus your first. And for anybody that's usually saying that, most of them haven't been operators,
right?
Also, from what I've seen as well. But the operators, I've done that for businesses actually, where I go in and initially I'm helping them out with marketing, but I realize, hey, there are 10 other categories that you kind of have pitfalls in. Like, I help people with filing their estate taxes and filing their franchise tax and all of these other things, because not actually doing it for them, but showing them like the right places to do and actually establishing those workflows for it. Because if you don't have those, the back taxes sometimes can really, screw things up as well. And I've seen some of that stuff too. So it's always important to actually keep those ducks in a row, for sure. And so
we'll have to talk offline about who these investors are that think of VA as a bad hire.
No, so not a first hire. They didn't say a bad hire, but for pre-seed. But yeah, we'll talk offline about that, because I've actually I've heard that a couple of times for people that I've talked to. But let's go into the next thing here. So the financial challenges for startups. I know we've kind of brushed over a little bit this with the conversation, but let's dive in a little bit more for, what are the most significant financial challenges that these early companies are facing, and, how can they be mitigated?
So this is an interesting question because a lot of the financial challenges I think you create by taking your eye off the ball or the focus or whatever. I'm reminded of we were fundraising at one of the companies I was at, and we were meeting with investors. And I remember the meeting clearly because we were probably halfway through our Series B. And so this happens very often. Sometimes you'll start a round. Let's say you start a $5 million round, and you keep looking and looking, and you can't find that lead, right? So you get checks. People come in on the terms you have, and the expectation is that, okay, well, once we get a lead, these terms could change. You'll get the best terms, but you're collecting money. And we were like halfway through, and we were looking to this investor to be a lead or to be a significant portion. And they said, well, we'd like to be the last check in. And I thought, well, everybody wants to be the last check in. That's, of course, that's logical, but they took it a step further, and they said, the reason why is because we find that companies in your situation will tend to get ahead of their operating plan.
Yeah.
And we looked at it and we were, oh, that's not going to happen to us. And then 6 months later, that happened to us. And what that means is that, okay, I've got a plan to raise $5 million, and I've got a plan to spend $5 million. If I only raise $2.5 million, I have to modify my plan.
Yeah.
But we didn't. We assumed that next $2.5 million is going to come in. And so we were working off of that plan, right? And one of the challenges with founders is I'm pitching this plan. I'm pitching the $5 million plan. So I've got to pitch the $5 million traction. With the $5 million traction means I've got the $5 million spend on marketing to get the $5 million revenue number. And so we were doing all of that. And we should have reset our plan. We should have said, okay, well, we've only got $2.5 million. We need to reset to a $2.5 million plan. And when more money comes in, then we can adjust our plan. But right now we need to spend to the $2.5 million. Instead, we spent to the $5 million, which meant we got ahead of our plan, which meant we now started to run out of money. And when you're running out of money is a terrible time to raise money, because now you're having to pull back on marketing. You have to pull back on new releases. You have to pull back on sales hires, and you're not hitting your numbers, right? Because I'm not investing in the business. I'm trying to conserve cash. And so now when you go in and you pitch investors with your $5 million plan, you're not hitting your $5 million plan metrics. And that just spooks investors, because they're looking at it thinking, these guys aren't hitting their plan. If I give them money, this doesn't sound like a good investment. And so that's one of the really hard lessons I learned early on is you've got to size your spend with your cash available and stay consistent. And if your fundraising plan gets slowed down, your spend has to slow down. And then have to be adjusted. And you have to adjust your metrics, and you have to say, hey, we've only raised half of our plan. We've adjusted our targets, and now we're executing on the $2.5 million plan, not the $5 million plan.
Yeah. Exactly. And also setting those expectations, I think, are very important. And also curious as to, ways to do that. And that might be something to talk offline about as well. But I know that's something that we've experienced is, we completely have bootstrapped the business for essentially about over a year now, right?
Yeah.
And, gotten significant amounts of traction, but everybody always says, okay, when is everything going to be out? When is this? When is this? When is this? And I mean, we have the plan for, the $2 million raise, but we also know what we can do with the current assets. Like if we continue to bootstrap, where we'll be. Obviously, we will want to have the funding to be able to fast track that and get to these other points, but being able to actually address, hey, if we don't get a dime of investment, this is where we're going to be. If we only get half of this, this is where we're going to be. And really adjusting those metrics, bare minimum monthly, where you're actually pacing everything out, especially if you're, not a CPG company, but what is it called? A technology company, where you actually know what these development sprints are looking like and actually putting that time and effort in to figure out, okay, if we don't put any money into marketing and we put it all into this section, what are the outcomes of it just going into this section and all of these other aspects? Yeah, it's extremely important for every company to do that, because otherwise you can lose credibility very quickly, as you stated.
Yeah, and there's no easy answer for that. I mean, the challenge of fundraising is the best time to fundraise is when you don't need money.
Yeah.
Because that's when you're executing to your plan, because I've got the money to execute to my plan, right? It's when you put it off, or in the early stages when you say, well, we can't do anything until we raise money. That's kind of another mistake that I've heard founders say. It's like, well, here's my strategy, here's my target list. And say, well, how many people have you called? Well, that's what we're raising money for, because we need to hire people to call the people on this list. And I'm like, well, pick up the phone.
Yeah, exactly.
You can call people. You can call 100 people on that list. And don't wait until you raise money to take actions to reduce the risk that investors are looking for you to reduce, right? And that kind of creates traction if you're willing to do those things, which is why it's great if you're a software company and the founders are software developers. It's like,
yeah,
we can do what we need to do
move a lot faster
out there, right?
Yeah.
That's kind of it's a big challenge. I mean, you see it all the time. It's everybody wants to raise money to be able to pay the people to do what needs to be done.
Yeah.
And I think that spooks investors when they get a sense of you're raising money to run payroll for the founders, which is like, okay, do you want to be a founder or do you want a job? Because if your goal is to raise money to get a paycheck, then that's a job. It's not being an entrepreneur.
Yeah.
Unfortunately, one of the reasons why I haven't started a company is because I need a paycheck. And until I get to the point where I can go, 12 to 18 months without paying myself, I don't have the financial flexibility to start a company and go all in. And so I think that that's what I encourage people to do is, okay, well, make sure if you want to go all in on this startup, make sure you have the financial resources to do that. Because if you go out to the market and try to raise capital from angel investors to pay yourself, it's making it hard to raise capital. I mean, you can do it, but it's just harder.
Yeah. And I think it's also extremely different for businesses that are a lot more capital intensive. Like for our business, completely different than the other two startups that my co-founder and I have founded previously, right? Very low cost, low barrier to entry. You can get a good amount of traction, a good amount of, funding. Like we didn't even fundraise for either of those two businesses before because there wasn't really any need, right? And so being able to look at, venture capital, but also other potential avenues for capital as well. Like there are over 60 different areas where you can get capital from, and less than 1% of startups actually are able to raise venture, right? 150 million startups globally. And, I think there are 79,000 venture-backed startups in the United States. So looking at those metrics, venture isn't always the way that everybody has to go.
Yeah.
But you also have to make sure you're looking at your business realistically, especially from the financial part, and actually having the funding to jump in and, be able to do everything else. And, it's okay to also, if you're not raising venture or doing those other things, like do it on the side for a little while, build it up, and then actually go in when you have enough capital or the business is generating enough revenue to go full time. Because most people aren't going to want to just pay your salary, right? Like that's something that's probably not going to happen. And if anything, for startup teams, usually you're operating at around 80% or less of, what a lot of these engineers or other people would typically be making, where, people aren't going to be making $200,000, $300,000 in other avenues. You're going to be making significantly less than that until the business can sustain itself. And then maybe everybody will be able to be paid more.
Yeah. Like 10 years ago, I think it was kind of the going rate for a founder CEO in Austin was about $10,000 a month.
Yeah.
So if you, and I see it's higher now. I mean, I'm seeing founder CEOs now making 20,000 a month. But you've got to understand what your investors think is appropriate, right? And it may be that you pass on a certain investor if they're thinking you should be making nothing or 10,000 a month, and you're thinking I need to make 20,000 a month, or market for what I'm doing is 20,000 a month. And so I don't know, it's a tough one.
It's a tricky situation.
Yeah, it's very tricky, because I think the ideal is to be the entrepreneur, to focus on what do I need to do to grow the business, and focus less on what do I need to do to make sure I get a paycheck.
Yeah.
So
exactly.
I can pick up on that pretty quickly when I'm talking to founders and they're talking about raising money and why they need to raise money. And if it's payroll is the focus and it's payroll so I can get paid, I'm like, okay, you need to shift your focus, because that doesn't play well with investors.
Yeah. I mean, speaking of investors and how things do and do not play well, let's talk about equity management strategies. So how should founders approach equity distribution amongst themselves, their early employees, and the investors? And what key factors and best practices for managing equity splits for early ventures kind of come into play?
I am a big proponent of milestone-based equity grants for founders. It's something that's talked about in the book Founders Dilemmas. And I mean, I encourage founders to think about it in these terms, right? Because a lot of times you start a company, and there's one example I saw recently. 3 founders, they split the company 3 ways. But they were each bringing something very different to the company, right? 2 of them were like rocket scientists, and the other one was the business person. And that's a different amount of value that those 3 bring to the technology that they were developing. So that's one issue. The second issue is people are in different phases, in different stages of their career, right? And so some founders, like the discussion we just had, some founders need a paycheck. Some founders have a nest egg or have built up savings that they can, focus on. Well, I don't need to be paid for 12 months. Some founders are going to stay with their full-time jobs and work part-time until fundraising happens. And so until everybody's in at the same level of commitment, you can't split everything evenly. And so I encourage people to do milestone-based, set up probably 3 or 4 milestones before you get to your first preferred round. And those milestones are probably similar to what's happening in customer development. If you follow a lean startup methodology, look at what do I think I'm going to accomplish during customer discovery, customer validation, customer creation. What's going to happen? Who's going to do what? And at the end, right, maybe you are going to get to a 33% split across your 3 founders, but each of you have contributed what needs to be contributed during the phase, and it's going to be uneven until you reach that point of success and you're all done, and now you've raised your Series A. And at any point before Series A happens, you want to be able to get that founder stock back. If, for instance, somebody says, okay, well, yeah, I thought I was going to quit my job and join full time, but I just got a promotion at work and I really, my stock, I can't leave. And so now you're thinking, well, how do I manage the fact that this non-participating founder has 30% of the company?
Yeah.
Because once you go, I think, above 5%, so investors look at the cap table and they're like, who's invested in the success going forward? There's not a lot of focus put on what happened in the past. I think milestone-based vesting helps with that. So you can say, well, John, for lack of a better name, John Smith has 7% of the company because he developed all the code. And then, for whatever reason, he had to move his family to Lithuania, and he's not part of the company anymore, but he still has 7% because he developed the code base. Investors can look at that and say, okay, well, that makes sense. But if you don't have that, thought process of what is John contributing, right? Now John has 7% of the company, and the investors are like, well, what did he do? And where is he now? Because we're putting money in for the future of the company, and we want to know that you have enough equity available for key hires going forward. And so they're going to look at that employee stock pool. They're going to say, well, we want it to be at least 10%, or they're going to look at the key hires that you have to make, right? You still need a CTO, right? Because John went to Lithuania. And so what is the going rate for a CTO at this stage, right? It may be 5% equity. And they're like, okay, well, do you have enough in your option pool to do that? And if you don't, they're going to make you put it in before their money comes in. And so everybody will get diluted in order to increase your option pool. And then the investors will come in, because the investors won't get diluted to increase the option pool.
Yeah, exactly. And I mean, some of those conversations can also be extremely difficult. I mean, I've had one of those conversations in every single startup that I've been a part of. I'm a 3-time founder myself. So I've been very, very, very lucky for all of those companies that I've been a founder in, to where those equity conversations were very easy based off of the relationships that I have with those individuals.
Yeah. And
most of the time, from what I've heard from other founders, it sounds like that is not the case, to where, it might not just come down to this magical mathematical equation of, I did X, Y, Z, and therefore I get this, or, this was my idea, therefore I get this amount. But I've also put in this, or I put money into it, you haven't. It can get very convoluted very quickly. And it's something that for a lot of companies, you really have to get right on that first try, because going back and changing some of those things may not be something that's going to be very easy or even possible to do in certain fronts. I mean, for the last startup that Ross and I were with, we had some debt equity on the cap table, to where, there's no point, go ahead, wash our hands clean, start something new. If anything happens with it, we've still got the technology and the IP and everything, and maybe we'll be able to do something with it if that, co-founder wants to, do something with the company. But it can legitimately, kill a startup, to certain points as well. And so really taking that into account when you're making those equity splits, and especially when new co-founders come in, because that's what happened for one of the previous businesses as well, is I was not one of the initial co-founders, right? Came in 2 years later, pre-launch and everything still as well, amazing technology. But, 40% of nothing is still nothing, 20% of nothing is still nothing, right? And that's something you have to really look at as well when you're going through and trying to, you can't just also build up a business and sell it as well for everybody tuning in. You have to actually make sure you're building something that is already in the market, has metrics, and is being used. You could build the best technology in the world, but if it's not proven or tested out, a Fortune 500 company isn't just going to swoop it up because you say it works.
Right.
And so, for
and the next those discussions is before, right? Because at the end, when you find out that somebody thinks that just their idea is worth 15% of the company, if you'd had that discussion up front, you could have gotten on the same page and said, well, that's not realistic, and this is what I think it is, and come to an agreement before you partner on something like that.
Yeah.
Because one of the things I encourage founders to do, and I see it across the board, and you probably know this, right? When you sign your option agreement, especially if you're signing a restricted stock purchase agreement, you sign the form that allows the company to exercise your options and buy them back.
Yeah.
So in advance of getting that stock, right? So let's say you have a grant for 100,000 shares, right? It's going to vest over 4 years, but you're allowed to purchase it now. you sign a form that says, if I leave, if I stop being a service provider, you can buy back my stock on that date, right?
Yeah.
I encourage founders to do that.
Yeah.
If somebody, because it's at the company's discretion to buy that back. And I think it sends a wrong message if you let somebody stop being a service provider, but you let them keep vesting on their stock. Because it doesn't stop vesting unless you purchase. You have to exercise your right of repurchase, which person's already signed. And so all you're really doing is you're countersigning it and sending them a check. And whether they cash it or not, that doesn't matter because you've got all the paperwork in place. But I've heard founders say, well, I don't, I still want them, I want to be on good terms with them. I don't want to, I don't want to piss them off by buying back their shares. Well, the thing is, you've got to treat everybody equally. And when people leave for whatever reason, you've got to fall back on the agreement that was made, right? And the agreement that was made was it's going to vest on this schedule. Yeah. And so now you've got to, as the founder CEO, you've got a responsibility to the company to, put that equity to work somewhere else. And you do that by repurchasing those shares and following the agreement that, okay, this person's not with us anymore, and we're going to buy back whatever 32% of the shares that haven't vested. And that happens for early stage, because when you're doing the restricted stock purchase agreement and they're buying it at par value, they're paying you $10 for 100,000 shares, right? And so that's the cheapest you're ever going to sell your stock. And so when those co-founders, when those very, very early employees leave, you need to get it back. And you need to say, okay, well, you're not a co-founder anymore. You're not an early employee anymore, whatever. We're going to exercise our right to repurchase.
Yeah, exactly. I mean, that kind of answered one of my next questions as we were going through as well about vesting schedules. But to moving into, financial modeling and forecasting, what are the essential elements for a robust financial model, and how should these models evolve as the company grows? And also, if you have any additional, common mistakes to avoid while building those out.
Yeah, I think that your financial model goes through different phases. Early on, like when you get together with your co-founder and say, hey, let's start this business, you're just like you're taking a broad stroke and you're saying, okay, we think we can do X. Here's the core metrics of this business. This is what the typical business model looks like. And you do a very simple model that says, here's what we think the gross margin is going to be. Here's what we think we're going to spend on sales and marketing. And this is how much cash in very general terms we think we need. And then you start working on your business and you start realizing, what it takes, right? You get a little deeper into what does the team need to look like? What is our chosen channel to get to the customer? What does it cost to acquire a customer? And now you're learning all these different metrics that are driving your business model.
Yeah.
And you start putting those into your forecast. And so now you're using these metrics that you're learning about, right? The cost to acquire a customer. This is how much I'm going to spend on trade shows this year. This is how much it costs me to hire a developer that knows this particular language that we're using. You start to learn all those specifics, right? So now you're building out more detailed forecasts to say, these are the metrics by which our business is going to run. And so we're going to forecast what we think will happen with these metrics over the next 12 to 24 months. And you're looking at a monthly forecast. And I used to do this back in the early days, back when I was doing this stuff for free. So you get what you paid for. So I used to have a 12-month forecast that was monthly, and then I would flip to annual forecast for the 5 years. So first year was monthly, years 2 through 5 were annual. And it was just the most bastardized way to build an Excel model. When now you just start with the monthly and just extend that out, right? And do 3 years. 36 months, I'm just going to extend my formulas out and I'm going to look at them annually, but I'm not going to try to forecast annually, because you lose the granularity when you switch from a monthly forecast to an annual forecast. And what you're trying to do in the beginning is understand how do these different metrics influence the operation of my business. And that's what you want to watch from a kind of a leadership standpoint, monitoring the success of your business. You're watching these different metrics. Well, those metrics need to be in your financial model. And you want to be able to look at them on a monthly basis and say, well, okay, I thought if I spent 5,000 on marketing on this channel, I'd get, whatever, 200 marketing qualified leads. How many did I get? I got 175. Okay, what do I need to learn from that? And how do I need to change A/B testing on my messages or whatever? And so you're refining the different levers that you have for your business, because your forecast is built off of those levers.
Yeah.
And then you go to the next stage, which is more department level, right? So in the early stages, when you're in customer discovery, customer creation, you've got like a small team. Everybody's doing everything, and you're all focused on finding product market fit. When you start doing functional departments, when you hire a CMO and they start hiring marketing people, when you hire a VP of sales and they start hiring salespeople, now you've got departments, and those executives or team leaders that are running those departments need to be tracking their own metrics. Yeah. And you need to be understanding how they're doing their business, how they're tracking their success, but not necessarily modeling that at a company level. And so their metrics are inputs to your model, but they're abstracted. And so they're modeling the details. Like I worked with a guy that's doing direct to consumer sales, and I mean he was looking at ad spend daily. He was looking at how many times the phone rang daily. Yeah. But we rolled his metrics up into, okay, well, this is what we expect to get from you on a monthly basis. I'm not modeling daily ad spend in a company-wide forecast. But he's got a department that he's running, and he's running it down at that level. But his goal is to exceed the monthly goals that I have for him that then roll up into the company forecast. And so that's when you start getting into kind of more abstracted, because you've got departments that are managing those detailed metrics. And the company-wide forecast is abstracted. That's like Series B, Series C, later stage companies where you've got very talented department leads that are metrics driven, and their metrics can flow up into expectations at the company level. And then when you're $1 billion company, you're now, your percent of sales forecasting, we spent whatever 23% of revenue last year on sales and marketing. This year we want to spend 22% of revenue. And you're saying, okay, well, we think revenue over the last 3 years, it grew 13% per year. We think we're going to do these strategic initiatives that'll get us up to 15%. So you're like very high level percentage sales forecasting. And, we was at a startup where we brought somebody in from a large company, and she was worried because the forecast was off by like 25-35%. And the company she came from, if they were off on their forecast by 5%, it was a company-wide emergency. It was like headquarters was on fire. We got to figure out what happened that we weren't expecting. But when you're at an early stage startup with, looking for product market fit, you're going to be off by, plus or minus 200% every month, because you're still learning what's going on. But when you're at a well-established company, things don't move that much, right? And so your variance to plan is, less than 5%. If it goes above 5%, people are freaking out. And so she had to make that shift where it's like, okay, it's not hair on fire. We're just learning from, well, what happened that we didn't expect? What do we need to change next month? And so I really got off on a tangent there with forecasting, but I hope that answered the question.
No, it definitely does, and I mean, I've been in that boat as well in some of the corporate jobs that I've had, especially on the sales side of things, where especially like COVID was the big outlier that happened during that time, where that around 5% variance, where if something ends up ticking over that mark, it's a problem. It's a very big glaring red flag, and then everything has to really be adjusted to fit into, okay, like, how did this happen, what went wrong, and how do we adjust to fix it to get back on track to where we were if there's a major loss. If there's a major gain, then that's a different story. You're like, hey, how do we do more of this? But most of the time when people are running with their like chickens with their heads cut off, it's because that something wrong happened, not necessarily something amazingly right. And especially for the preface of, like, that's for Series B and later companies, but for a lot of these pre-seed companies and seed, but mostly the pre-seed side, like, they're looking at your financial model because these are assumptions, right? And everybody knows these are assumptions, but really everybody's looking at how are you thinking about your business, how are you articulating where you want to go, how you're seeing what this plan will actually do, and how you'll actually go to market with a lot of these different factors and different channels and streams, right? But if you aren't actually thinking about that, then that's already a major red flag. If you aren't thinking about it in the way that the market typically does, that could be a red flag. It might not be. If you're in a moonshot type business where it's revolutionary, I don't think that so, like, you might get pushback, just like Bezos, Jobs, everybody else got pushback when they did these new innovative things with their go-to-market strategies that people thought they were crazy for. But those are also 1,000 out of millions, like hundreds of millions of startups that have tried and failed.
Yeah.
None of us can really assume that we're going to be a Jobs or a Bezos when we're actually coming up with these marketing strategies. And so figuring out what's tried and true and maybe doing some variation. But if you're going to try to go for that, then maybe reevaluating a VC is right for you, or if it's a low cost barrier to entry, then do it and then prove everybody wrong.
Yeah, there's so many different ways you can go with that, because there's a challenge to thinking, well, I'm the next Steve Jobs.
Exactly.
Everybody'd love to be the next Steve Jobs, but unless you've got that kind of charisma and can convince, and again, like, I was just looking at it. Actually, I was looking at the Facebook funding history, right? And they didn't raise a lot of money in the beginning.
Yeah.
But they knocked it out of the park on their metrics. And so each round just kept getting bigger and bigger and bigger. But like in the early days, right, it was tough for them to
Very
get
minimal.
First $500,000 check from Peter Thiel. They kind of lucked out being in the right place at the right time with the right product.
Yeah, exactly. And that's also with that strategy,
it's one of those things, right? I work hard. Work hard to increase your chances that you'll get lucky.
Yeah, exactly. And I don't think any of them, I mean, probably maybe all of them thought that, this is going to be the next best thing, or, we're going to hit these crazy and amazing metrics. But also, I could name at least 100 founders in the last 4 or 5 months that have told me the same thing, and their companies are shut down right now as well. So just because, we believe that we have this amazing go-to-market strategy that nobody's ever thought of before, or whatever else it is, doesn't mean that it's actually going to pan out that way. And we all can't use the excuse of, well, if I just got, this one investor, if I just got a little bit of money or whatever else it is, because that's not really how the industry or just business in general works, startup or not, to where, because a lot of people have also seen people just burn through cash, where, you give somebody $1 million plus or whatever else it is, and they have the exact same kind of, doe-eyed, happy look on their face. And then, you just burn through the cash very, very quickly because they didn't really know how to spend it, or they didn't do some of these financial strategies that we're talking about and discussing. And so that's why they're extremely important, because it's not just, and I've said this before and I'll continue to say it, it's not about you raising the capital, right? That it's about, what do you do after you've raised the money, right? What do you do after you get to this next milestone? Like, what is the micro and macro view on your business? Because like, funding can only take you so far. Like, you can see, crazy businesses, and we've seen some of them very recently and over the last, couple of years, that went up very fast and then completely just collapsed. And it's not something that, history hasn't seen before. We've seen it time and time again with several companies each decade, that get to these amazing heights, and then they either can't sustain it, or they just kind of blow through all the capital too. So it's not just the small ones that are seeing this. It's also, major behemoths that come out as well.
Yeah. I mean, there's so much money going into AI right now, and we think that companies are unstoppable. But I mean, OpenAI could end up shutting down, right? They're just as susceptible to failure as, Llama or Gemini or any of the other products out there that are being developed. And it's like,
I mean, we saw it earlier this was it this year or last year? Yeah. I mean, we saw it earlier this year, last year. The stuff with, Sam Altman leaving and everything else, and how quickly the employees kind of shifted, and how, like, just one brick was removed from, this amazingly large and fantastic tower, and then, pandemonium hit when just that one thing happened. And I don't think anybody, and I spoke with so many people in the AI industry, because I mean, we're implementing artificial intelligence as well, and machine learning into our systems. And so we were having very, very in-depth discussions, because this is during the time when we were building our advisory board. And so that was the constant question that kept popping up for us. And also, we were also, talking to potential engineers that we were going to be bringing on, and everything else. Is there was this major fear around artificial intelligence during that time of, is this sustainable really in the long run? And obviously the answer is yes. I mean, I don't think any of us see AI going away. But on the company side of things, what really makes an AI company? I think that, we are a centralization and data company. But to say we're an AI company is extremely naive, because in 5 years, there isn't going to be really a category of AI in the name, or it's going to be a moot point, because every single company will be utilizing AI in some way, shape, or form. It became this amazing thing that kind of turned into a buzzword. And so, yeah, that's something that, talking about some of those pivots and things that people have to make with their models. If you're thinking that, AI is going to be your major selling point, you missed that boat by about 2 years. So, like, if that's going to be the main thing you thought was going to drive your business.
10 years ago, it was blockchain, right? It was, we're blockchain this, we're blockchain for this. And, now it's AI. We're AI for this, we're AI for that. And so, but you're right. In 5 or so years, everything's going to have some component of AI in it. And it's not going to be a differentiator anymore. It's going to be table stakes.
And I mean, we're also seeing it now anyways. Yeah, we're seeing it now with a bunch of these companies, to where it hasn't become, I know we kind of shifted the end of the convo into AI, because we're going to be wrapping up soon here as well, because we're almost at the top of the hour. But that it happens constantly, right? And the term of history repeating itself, and whether we learn from it or not, is always going to be a thing. For the .com bubble, the blockchain aspects that kind of happened, and now it's artificial intelligence. In 5 to 10 years, or maybe even sooner, we might not even know that it's out yet, or maybe some people do and we haven't, been really told about it. There's something new or some wave that's going to come in that's going to take everything by storm. And I know one of the big things right now that people are talking about, but not really emphasizing as much, is what is it called? Vertical SaaS, right? These like looking into vertical industries and actually looking at the technologies that are going into these non-sexy areas.
Mhm.
Uh, that's something that I think the technology that's being built there is where a lot of people are starting to look a little bit more closely. And so for startups that are building in those spaces, I would say look out there for what options are available. And that's all I'll say about that. If anybody wants to talk a little bit more about that offline, definitely love
I,
to.
I think there's great opportunities for little vertical SaaS companies that can be really successful for the founders. You got to figure out how to do it without venture capital.
Exactly. Yep.
VCs need, big markets. They need companies that can eventually go public. And so if you can be very successful with a vertical SaaS company that's making anywhere from 50 to 100 million a year in revenue.
Yeah.
That may not be an IPO candidate, but it could make you as a founder very wealthy to figure that market out and to be successful in that market. And I think I went to a talk maybe about a year ago by Mark Ralston, and he's here in Austin, and he talked about AI and software in general as being disposable. And so he envisions a point where we're going to get to that a program is created to do what I need to do, and then it goes away.
Yeah.
And I think about that kind of in the context of vertical SaaS or just looking at other solutions and think, okay, is there a way to abstract this to say, okay, what would it look like if it was a disposable application? And I think that's some technology that we're going to see in the next few years that is just going to blow everybody's mind away to think, wait, you mean that CRM that I used last month to send out that list is gone? And now I've got a new CRM that is actually serving a different purpose, and it's working on my data in a different way, and it's leveraging it, and it's now a unique program that I'm using to solve this new problem. And so I
Yeah.
think that the technology is, and I'm a big proponent of lean startup, right? So the technology is getting simpler and simpler every day. And so if you
Yeah.
think that you're differentiating yourself based on technology, you're going to lose.
Yep.
The goal these days, I believe, right, is to differentiate yourself on how you solve the problem and how you understand solving the problem, because that's
Yeah.
what's unique. And that if everybody's out there focused on, well, I'm going to build the next best technology or the next best AI wrapper for OpenAI or whatever, that can be replicated very easily. But your ability to understand and meet the customer at their point of needing a solution is what is going to differentiate you. And that's why
Yeah.
I keep the companies I advise, I keep kind of bringing it back to that, right? I know you want to add more features. We need to know that the customer is getting value. And we need to
Yeah.
know that we can measure that value, because once we see that value unlock, then we want to go all in.
Yeah.
Because it's not another feature, it's not a more complicated implementation. It's, do customers, when they have that aha moment, I want to know it, and I want to see it in the software, and I want to trigger it, and I want to essentially tell them, hey, you just had this aha moment, right? And maybe something different.
Yeah.
I'm not a marketing person, but that value unlock, I think, is where the future is, as opposed to, well, I'm an expert cloud engineer or Python engineer or whatever. That stuff's getting commoditized, and it's the ability to solve customer problems that is getting differentiated.
Yeah, I mean, you bring up this book all the time, and I'm going to bring it up for you because we haven't mentioned it yet. But the mom test, right? Being able to actually get that feedback and build. And I mean, you said the exact same things to us back when we were doing Founder Institute. Because for all of you all that don't know, Jeff is also a mentor for Founder Institute here in Austin, Texas, and also teaches entrepreneurship and a couple of other things as well. And so we want to. I wanted to make sure I highlighted that, but the ability to get feedback and build and just a constant cycle of that. If you aren't getting feedback, then you don't know what you're building. There's no point to build a bunch of features if you haven't talked to anybody and seen that these are things that they'll actually utilize. Otherwise, it's just wasted development time, right? I mean, you can have this great, grandiose vision, but you know, it's very difficult for companies, especially now with how many startups are out there, to actually say that we're building something unique or we're building something that's special that can't be replicated, right? Because I mean, especially with open source models now, it's few and far between for that. So it's really just like finding that beachhead market, getting those early adopters, making sure that they're advocates for you and continuing to build out from there. Because every single company that's grown, you know, significantly and been able to sustain that growth, which is the key point to this, to all of this, is like it's not just about getting all this stuff correct; it's about sustaining it. Um, all of them have done that, and if you research every single one of those companies, that's something that you'll find as a causality for every single one of them. And also want to thank you, Jeff, for telling me that, because you were one of the people that hammered that into me
Glad you remember.
rigorously.
That's encouraging to know that you took it to heart.
I did. Oh yeah. Like, no, you were one of the few people that actually helped us with changing how we were viewing a lot of things with the company significantly. I mean, for us, just getting the C Corp and starting to build things out and like all the pivots and everything else, like being able to find where we truly fit in the market and then continuing to show ourselves in the market, even with this not being launched, has been significant. I mean, the amount of partnerships that we've received, the amount of, communities that we're adding on, the engagements, things like this for doing this webinar, are all things that culminate into something greater. But yeah, like I want to wrap things up because I know we're over time here as well. And I want to thank you so much for coming on. I truly appreciate you coming and giving your time today and expertise and knowledge to everybody that's watching. For anybody that joined in late, the recording will be available right after this as well. So this will be up for people to review and continue to learn and engage with. And we definitely want to hear from you. If there's anything that caught your eye or that really resonated with you from the information that we talked about today. And I want to ask you, Jeff, I posted your LinkedIn in the chat here, but is there any other way for, people to connect with you after today's session?
That's the best way. I'm on LinkedIn every day. And so
yeah, sounds great.
Me on LinkedIn, let's continue the conversation.
Love that. Yeah. And so thank you so much. And for Founding Titans as well, we are still working on everything, still getting the platform up and running for all of you. And so definitely join our wait list. I'm going to post that for our website in the chat again here so everybody can have that. Foundingtitans.com. Once again, we're building a community-focused relationship optimization platform. We're building that to help founders find the right connections and resources for their businesses. If you guys have any more questions on that, please let me know. If you'd like to be on one of these sessions, also please let me know. We are going to put the Thursday sessions on hold for a little bit, just because due to fundraising season, we're also trying to be laser focused as well. Yeah. Everybody's in fundraising mode, but also this information that we're going to be providing will be very valuable for fundraising season. Next week, we actually have Anthony Abney on as well with what is it called? Was it Bronze Valley? Yeah. So with Bronze Valley, Anthony Abney is going to be coming on as well. And we're going to be talking about empowering the underrepresented. And so definitely make sure you come in next Tuesday. And then we also have a lot more sessions planned out all the way until the end of October. We're still filling out the calendar, so we'll continue to do these as long as people keep showing up and giving us feedback. So thank you all again, and have a nice rest of your day, and hope you all enjoy.